Hi, my name is Nick Cleary. I'm a partner with the Vantage Infrastructure Group. We're a credit-focused infrastructure specialist investing globally across the risk-return spectrum. Today I thought I'd talk a little bit about what's happening in the infrastructure credit market, but also the overlay with how that's being influenced by energy transition opportunities, and particularly in the US mid-market space. So first of all, in terms of infrastructure credit, I think this year and probably for the next couple of years, it's going to be one of the most compelling times in infrastructure credit. Senior debt in infrastructure credit's delivering 8 to 10% cash yield. Junior debt is well above that. So what that means today is infrastructure from a credit perspective can achieve what were the sort of core infrastructure equity-like returns, albeit with a 100% cash yield, which has made it more relevant to the real asset allocations, perhaps somewhat tactically, but also that level of return and the risk profile of infrastructure credit is increasingly attractive to the private debt allocations. Probably one of the areas in the market where we're seeing probably less appetite today is from fixed income investors, with where corporate and government bonds are at 4 to 6%. Investment grade infrastructure credit's probably less appealing than it was when rates were lower. One of the most underappreciated areas we see today in infrastructure credit is really what's happening in the mid-market space. And this often sits between those bookends of long-term investment grade and junior debt. It's typically senior secured, it's floating rate, it performs with an investment grade quality but has a high yield return profile. And this is one of these areas that I think is most adaptive to lots of different allocations, whether it be real assets, fixed income, or even private debt. To put some numbers around the opportunity from a US market context, for example, the US issues around $300 to $400 billion of debt per annum that has an infrastructure debt profile. But if you break up that detail, about 40% of the transaction volume has an average deal size of less than $200 million, which we typically call mid-market. Those transactions are typically 3 to 7 year tenor, floating rate, 4 to 5% margins that today is sort of delivering 8 to upwards of 10% returns. And that's a market opportunity that is sort of underappreciated, small relative to, I think, some of the larger parts of the market, particularly the bank and bond and even term loan B parts of the market. But it's a very large and diverse opportunity set that we've been investing in for a number of years. And I think investors now are starting to realise it's an underallocated and underappreciated niche in the market today. However, one of the challenges of the mid-market space is by its nature it's more complex and they're smaller assets that require more careful and thoughtful tailoring to not only sort of achieve a good return for investors, but first and foremost to achieve a sort of a value add debt financing solution. So that takes quite a bit of experience to know the underlying asset, know the sponsor's objective to come up with a flexible debt solution that creates value for all parties involved in the transaction. And that's where the opportunity in the US is quite unique, because the US does have some very competitive capital markets from banks and bonds and even some of the leveraged loan markets. But those markets are very much tailored around generic debt solutions to corporates. And infrastructure is relatively new in the US market and it's expanding and diversifying. So there's quite a lot of appetite from sponsors to look at different financing solutions that can generate the value for the equity funds and their sponsor objectives while delivering great outcomes for the credit investors. Again, speaking of other areas that are underappreciated in the US, I think one of the areas people miss about the US investment opportunity is it's not a sort of government regulation, federal government top-down driven homogeneous investment opportunity. The US is probably one of the most diverse and fragmented investment opportunities globally. And what that means is where we see a lot of the investment flow is not just at a state level, but at a local government and local agency level, and across different agencies in different states, taking very different approaches. So again, a more flexible mid-market opportunity and a mid-market investment approach provides great access and diversity. And so I think that's certainly one of the things we hear from our investors, who might have more mature portfolios in other markets, the ability to invest in the US, to quickly gain diversity across a range of states, a range of sectors and a range of deal risk return profiles is quite compelling. And we typically find the mid-market is where that is most accessible, and obviously offers some of the most attractive risk and returns we've found over the last 10 years. So that was a bit on infrastructure debt, and particularly with a bit of a focus on what we're seeing in mid-market US. I think one of the other key themes we're seeing, not just in the US but globally, is energy transition. And I think what we've seen over the last 10 years is probably moving from maybe a phase of bubble and hype about the potential of energy transition to more recently moving into it being a relatively core infrastructure risk profile. Whereas a few years ago, there was probably a bit too much technology and market development risk outside of core utility scale renewables for it to be a persistent and reliable investment opportunities. 10 years ago, energy transition was 100% renewables and around $200 billion. Today it's over $1 trillion, it's 50% renewables, and the other portion that's not renewables is incredibly diverse across carbon capture and storage, energy efficiency, a range of circular economy and sort of more broader net zero efficiency, ESG driven investments. But the big mover in that is certainly electrification. Electrification of transport, electrification of heating. And that really speaks to the growing diversity, that energy transition is no longer just renewables. It's a very diverse and it's a very readily accessible and investable opportunity. But there's obviously newer market and newer technology risks in that, and that's where infrastructure credit can be quite an attractive investment strategy to access energy transition, because with infrastructure credit, there's a lot better ability to tailor the debt structure to minimise exposure to newer market or technology risks. And it's also easier to diversify exposures than you can with an equity investment strategy. So we're seeing quite a few investors start to get quite excited about accessing energy transition at an earlier stage through infrastructure credit to start building their own institutional knowledge and experience in the sector, to know where they're better off to focus their longer dated and maybe more concentrated equity investments in the space. So if I was to call out two themes with energy transition that today we find most compelling and investable, it's probably storage, mostly batteries, but really paired with renewable generation and also paired with distributed generation. That's where we've seen actually growth, particularly through the residential solar industry over a number of years. And it's an area where you see less new market, new technology risk. Applying batteries along with renewables is a very proven technology in a somewhat new application, but it's fitted very well in the market, and we are seeing the investment opportunities ramp up quite significantly. One of the areas we always are a little bit cautious on in the storage space, often the revenue model for storage is not as mature as it is in renewables. They're not long-dated capacity contracts. You usually have to take some merchant or some energy volatility or energy market volatility risks. And again, infrastructure credit can be a great way to minimise the exposure to some of those new risks as those markets develop. The other area that I mentioned that we see a lot of interest in at the moment is the concept of electrification. I think the headliner of electrification, of EV and EV charging, is still gathering pace. But what we're seeing ahead of that is we're seeing the networks and the energy supply opportunities starting to adjust, and particularly strategic investors related to EVs coming in and providing the contractual support for those transactions, which make them very investable from an infrastructure perspective. And then the other area we're seeing within sort of electrification is really probably a hybrid of electrification of heating for buildings, because buildings are certainly one of the huge users of energy where there's a lot of low-hanging fruit of savings to be made, and switching to electrified heating can have a very meaningful impact with very simple technology. And the other area also related to buildings is energy efficiency. Again, this is another low-hanging fruit where applying very proven technology in very simple applications can deliver meaningful savings to the owners and users of those buildings and create a really unique infrastructure investment opportunity. So maybe to bring those two themes of credit and energy transition together, one of the areas where we see this coming together in a most compelling way is the US market. US market has probably been a laggard for private investors in infrastructure debt relative to the more mature markets of Europe, UK, Canada and Australia, but it's growing very strongly today. And even before some of the recent market disruptions, the growth of the investment need was not being caught up to from the debt financing. So there was already a gap that was quite attractive for infrastructure credit investors to step into. But the combination now of infrastructure in the US being more a mid-market driver, that was more reliant on regional banks. So with the market disruptions, some of the events related to regional banks, which has resulted in a pullback of bank appetite and less lending appetite for particularly smaller transactions, that's opened up even more white space for infrastructure credit investors. It's certainly improved returns, improved access, improved ability to diversify portfolios, and certainly in this environment has come with a quite attractive return premium compared to other credit opportunities in the market. So that's why today, when we look globally, we do see consistently a lot of opportunity across the risk-return spectrum in infrastructure credit across many markets. But the US mid-market with an energy transition focus is certainly one of the areas we find most compelling for investors, where we've been able to consistently deliver equity-like returns in senior debt, and we think that's a reasonably unique opportunity for investors today.